For months, we've been saying that we'd be willing to turn bearish the S&P 500 on a move to 3,000 to 3,030-ish. And here we are, and we still feel the same way about it. Despite supportive seasonals in the short run, meaning the next couple of weeks, the longer-term prospects, and in our view, longer term is the next couple of months, not necessarily beyond that, we think they look a little questionable. In fact, if you look at a seasonal chart that's offered by MRCI, the S&P tends to find a temporary top in mid to late July. On the fundamental front, the Fed Fund futures market is pricing in a nearly 100% chance of a rate cut later this month, in addition to high odds of further cuts throughout the year. We continue to believe that the interest rate market is way ahead of itself on this. If so, there's plenty of room for disappointment in the stock trading arena. Looking at a weekly chart of the E-mini S&P futures, we see that we're coming up against trendline resistance around 3,030-ish. Again, this is an art, not a science. So if we poke to 3,031, that doesn't mean all bets are off. It just means that markets are messy, and so that's something you should expect. But in general, in our view, the upside should be relatively limited. And on the downside, we see potential for a return to the bottom end of the trading channel, which would be somewhere in the 2,700 to 2,750 range, maybe even a little lower if fundamentals start to turn the corner. We'd like to keep an eye on the RSI, which is a technical oscillator, the relative strength index, and people use it for various reasons. Some people use it for trend trading. We like to use it to determine whether a market is overbought or oversold. The RSI currently on a weekly chart is in the high 60s and creeping up towards the 70 area. Historically, an RSI in the 70 area in the S&P on a weekly chart has been an area that tends to see buying dry up. Now, it doesn't work perfectly, just like anything else. If you might recall the rally of early 2018 when the stock market went up every single day for months without any kind of pullback at all. In that situation, we saw the RSI get up to 90 before it finally flipped over. So there's no guarantees that the market's going to turn around just because the RSI is around 70, but the odds are buyers tend to be much more reluctant at that particular point. We also like to look at Bollinger Bands. Bollinger Bands are basically a visual representation of the bell curve. That's the easiest way to explain it. In theory, the market stays below the upper band and above the lower band, so in other words, between the Bollinger Bands, roughly 96% of the time. Keep in mind, when it does break the band, sometimes it can do so dramatically. And although those moves are generally temporary and the market generally reverts back into some sort of a equilibrium price within the band, those moves can be rather large. So it's not a perfect indicator just like anything else, but it's a tool in the tool belt. So to summarize, we see relatively limited upside potential. While we see a decent amount of downside potential, we're not pessimistic in regards to the markets. We're not looking for some sort of crash or anything dramatic like that. We just simply think a pullback's in order.